Hi, I'm Marcel with Guaranteed Rate, and I wanted to answer some questions for you. And it's actually one of the questions I get quite a bit, and it's in regard to points. And so, points is something that we throw around sometimes in the mortgage business pretty freely. And, realtors can talk about points, but the general consumer isn't really aware of what points are. So, I want to take a moment and just kind of explain that to you. A point is going to be equivalent to 1% of the loan amount. So, for example, if you have a mortgage and let's say the loan is going to be for $200,000, 1 point is going to be the equivalent of $2,000. And so the question then becomes, well, okay, that's what a point is. What is it that a point would actually do for me? How does it help me on a mortgage? Or potentially, how does it hurt me? So a point is actually prepaid interest. And so with that, it does mean that at the time of closing, you are going to actually be paying more money at closing because you're prepaying some of that interest. So again, 1 point on a $200,000 loan amount is $2,000. So in essence, your increase in costs would be $2,000. So why would someone do this? Because a point will actually be used to lower the interest rate. For example, if right now you're looking at a mortgage and let's say that that mortgage is $200,000 in a market interest rate, let's just throw some random numbers out and say it's at 4.5%. If you pay 1 point, basically $2,000, generally the rule of thumb is 1 point will end up lowering your interest rate approximately 1/4%. So if you're paying 2 points, it could actually end up lowering your interest rate by 0.5%. Now again, these are rules of thumbs. These are not going to be your actual numbers, but to kind of illustrate how it functions, it's a good way to kind of set up. So if you're looking at paying for a point, in essence, that's going to end up lowering your monthly payment from 4.5% to 4.25%, which saves you roughly about $29.49 a month. And so with that, then we run a break-even analysis. A break-even analysis is basically when the cost of the points is divided out by the monthly savings, that equals the number of months in order to hit the break-even. And so with that, it puts us into a position to where a break-even is going to be roughly at about 68 months. So then the question is, okay, is this a home that I'm going to end up keeping for over 68 months? If it is, then yes, it may be a good idea to proceed with points because every month after that 68th month, at that point, because of the business decision that was made at the time of closing, you're going to be in a better position by roughly $29.49, 50 cents, something like that. So if you plan on keeping a home for less than those 68 months, don't pay points. So in essence, when you're looking at whether to pay points or not pay points, you really need to have a conversation with your mortgage professional and see how long is it that the break even is going to take and how long do you as a home buyer plan on living in this home. If it's going to be a very short window, then generally paying points is not going to be advantageous. However, if this is going to be your forever home, this is going to be the home that you're in for the next 10 years, 15 years, 30 years, then absolutely paying points can end up saving you a tremendous amount of money in the long run. In any case, Marcel with Guaranteed Rate. Give me a call with any questions. Be more than happy to answer those. 972-672-3246. And I hope you have a great day. Thanks.